Thank you for joining me this Friday, the 25th of August. I'm Grady for market analyst with Bell Direct, and this is the weekly market update. So far this reporting season, 192 companies have reported, with 64 beating expectations, 70 meeting expectations, and 58 falling short of expectations. 29 companies have been upgraded by brokers, while 23 have been downgraded. The supermarket giants released results this week with vastly different reactions from investors. In FY23, Woolworths reported group sales up 5.7% to $64.3 billion, which cements the company's leadership position in the Australian supermarket industry after Coles posted group sales revenue of $41.47 billion, which was growth of 5.3% on FY22, but fell short of Woolworths' growth. Across the broader metrics, Woolworths excelled in FY23, including gross margin as a percent of sales rising 26.8%, group EBIT up 15.8% to $3.116 billion, NPAT up 4.6% to $1.618 billion, and the final dividend rose 9.4% to 58 cents per share, while Coles held the final dividend flat at 30 cents per share. In response to the strong results, investors set the Woolworths share price up 5% intraday. Another staple stock that had investors clucking was in Inghams, with shares in Australia's leading poultry producer lifting 15% upon results being released. Throughout FY23, the company reported feed prices were moderating, which had been a headwind in previous financial years, as well as a return to longer-term growth outlook for FY24 being expected as volumes rise. From an operational standpoint, Inghams' revenue rose 12% year-on-year to $3.044 billion. Underlying NPAT rose 68% year-on-year to $71.1 million, and net debt was reduced to $394.7 million. The company is also allocating $100 million to CapEx in FY24 toward automation of operations. The Flying Kangaroo reported on Thursday, with the company continuing to reap the benefits of built-up travel demand post-COVID-19 lockdowns ending. Across FY23, Qantas reported underlying profit before tax of $2.465 billion, up from a loss of $1.859 billion in FY22. Statutory EPS came in at 96 cents per share. Net debt was $2.89 billion, which was below the target range of $3.7 to $4.6 billion. And FY23 group capacity returned to 77% of pre-COVID levels. Revenue for FY23 also jumped significantly from $9.108 billion in FY22 to $19.815 billion in FY23. Shares in Qantas traded higher on the result, and it has been a positive turnaround for the business that was claimed to be 11 weeks away from bankruptcy during the pandemic. Shifting focus to the mining sector, and as the theme has been with any company with exposure to China, the big iron ore miners have felt margin pressures and repercussions from uncertainty on the demand front from China. BHP shares dipped slightly on the release of results after the big iron ore miner announced higher inflation costs and lower commodity prices have hurt its key iron ore business. BHP reported a 37% drop in profit for FY23 to $13.4 billion, while revenue dropped 17% to $53.8 billion. As healthcare companies continue to feel the brunt of investor sell-off in 2023, Ramsay Health Care was the latest company to report earnings results that disappointed investors. The company's shares fell 10% after FY23 results were unveiled, and it unveiled the full-year dividend was nearly halved to 25 cents per share, while NPAT rose just 8.8% to $298.1 million. Inflationary pressures were the blame for higher labour costs. On the outlook front for Ramsay, no quantitative guidance was issued, but the company expects the current environment will dictate some change in the emphasis and focus on long-term strategy for the company, while expecting single-digit growth as the market continues to recover. Across the board, the key themes remain this reporting season. China exposure is hurting outlook for companies operating in the region. Margin contraction is an area investors are punishing this reporting season, and failure to provide quantitative outlook is an area of concern for investors heading into the new financial year. Locally, from Monday to Thursday, the ASX 200 rose 0.48% as a rally on the Nasdaq in the US fueled a rally for the local tech sector, with the tech sector rising 2.5% over the 4 trading days. Consumer staples stocks took a hit, with the sector closing over 3% lower from Monday to Thursday. Looking at the winning stocks and losing stocks on the ASX 200, Altium rose 30.42% on release of positive FY23 results, followed by Premier Investments rallying almost 16%. IRES fell just shy of 40% on the release of disappointing FY23 results, while Alumina also fell 15.8% from Monday to Thursday. On the broader market front, the All Ords rose 0.47% over the last 4 trading days, led by Mesoblast rising just over 43%, while Ordinate rose just shy of 30%. On the other end, Queensland Pacific Metals fell 25.81% over the 4 trading days, and Paradigm Biopharmaceuticals fell 17.5%. The most traded stocks by Bell Direct clients from Monday to Thursday were Iris, ResMed, Santos, Commonwealth Bank of Australia, BHP Group, Aussie Broadband, Pilbara Minerals, Hub24 and Telstra Group. Clients also sold out of PEXA Group. And on the diversification front, the most traded ETFs by Bell Direct clients were led by SPDR S&P ASX 200 Fund, Vanguard Australian Shares Index ETF and BetaShares Australian High Interest Cash ETF. Taking a look at the week ahead on the local earnings season front, we'll be keeping a close eye out for results out of Fortescue Metals Group, Mineral Resources, Brambles, IGO and Flight Centre. On the economic calendar front next week, JOLTS job openings data will be out in the US on Wednesday, with the market expecting a slight uptick in the number of job openings in July. Chinese manufacturing data is out on Thursday for August, with the forecast of a slight rise to 49.5 points in August from 49.3 points in July. And the flash inflation rate for the European region data is out for August is out on Thursday, with the forecast of a slight contraction to 4.9% from 5.3% in July. And that's all we have time for today. Have a wonderful Friday, a wonderful weekend, and as always, happy investing.